Good afternoon. My name is Martin A. Smith. I'm the president at WealthCare Financial Group Incorporated. WealthCare is a wealth management, retirement planning, and investment advisory firm. I wanted to take a moment to speak with you about the economy and the markets in light of the last several months with COVID-19, most recently the protests, how the market and economy is behaving, what I expect going forward. So just to recap, on February 25th, we liquidated the equity positions in our model portfolios. That includes small cap, mid cap, large cap, and just those positions because pandemic was starting and it made sense to get out and not lose money. I maintained the government bonds, I maintained the high yield bonds, and also maintained gold. Those three asset classes have performed pretty well. With one caveat, high yield bonds was doing pretty good, and then the Federal Reserve decided to slash interest rates, and I'll show you that on a chart in a minute. And so high yield bonds took a dip, and then about a month later, the Federal Reserve decided to stimulate by purchasing a lot of corporate debt, which was absolutely wonderful because then our high yield bonds went up, and thankfully I didn't sell those bonds, and so they're performing just great in the portfolio and our models. Gold, of course, great asset class to have, especially in times of uncertainty. And we also added utilities and consumer staples, those two sectors. Why? Because when people are sheltering in place, they are definitely going to pay the utility bill. And luxury spending goes out of the window, and they're going to purchase those essential products. So utilities and consumer staples added to our model portfolio was a good addition. Now I want to show you my screen because I like to illustrate something on a chart for you. So here's the day we sold, which was February 25th. The Dow at that point was at 27,081.36. So we got out just above 26,000, which was a pretty good place to get out because you see here the Dow dropped to a low of 18,213. So we cut bait around 3 o'clock, 3:08 to be exact, roughly, on the 25th of February. The Dow dropped to a low. And you know what? Yes, the market came back nice just a couple months later, but who knew how long this pandemic could last? Who knew how the Federal Reserve would respond during this pandemic? So it just made sense to cut bait, take profits, move money off the table, and let the market do what it was going to do until we got an indication of what was going to happen. Now, this light blue line here represents high yield bonds. You can see high yield bonds is okay. It was sort of, if I can get rid of that, it was sort of flat, doing okay, and then it just dropped. Federal Reserve wanted to slash interest rates, and so the high yields took a dip. Looks like this, the Dow category. But then the Federal Reserve decided to start buying corporate debt, which would infuse corporations with more capital, which is great also for the stock market, as you can see right here. And then high yields went back up. And here we are today. So I was pretty happy about that. Now I'm going to let's add gold to show you how gold has performed during this time of the pandemic. And let's make gold the color gold. All right, here's gold. Look at that. So gold did pretty well. But you notice that gold also follows the pattern of the anticipation of interest rates as well, because when rates were being slashed, gold's dropping. And then when the Federal Reserve started to pump money into corporations and buying all that debt, gold picks up because the anticipation is corporations now have more cash, and of course they can produce more, and there you see the impact on the market. Okay, now let's add to this mix here a new allocation in our model portfolios, which is Treasury inflation protected securities, or TIPS for short. Let's make that purple. And here's TIPS. Now, why do we want TIPS? Because if the market is moving higher, as illustrated in the dark blue line, eventually interest rates will rise. And when interest rates rise, that is to offset the threat of inflation. So if there's going to be inflation, then this bond here will move lock in step or in the same direction, is positively correlated with the anticipated direction of inflation. So I think inflation is on the future, on the horizon in the future. I expect that corporate bonds will continue to perform pretty well as the stock market, and therefore we want to add a hedge in the bond category of Treasury inflation protected securities. Let's also add long-term government bonds. We're going to make that pink. Now, you see long-term government bonds took a slight dip around the same time corporate bonds did, but not as sharply. And it was moving higher. And then, of course, now it's sort of flattened out. But notice the trend line as we get, closer to around, I guess that is May 18th. You can see that it starts to move down, and it moves down a little bit more sharply right around May 29th. And so if this is an indication of where of where long-term bonds may be headed, looking at third quarter, fourth quarter next year, you could see also why we have high yields in the mix here, as well as Treasury inflation protected securities. So again, having a balanced portfolio is key. Having a portfolio that is diversified by asset class is extremely important. And gold is one of those asset classes that is not positively correlated to the stock market. So I'm going to reduce this just to have the Dow, high yields, and gold. You can see the difference here. Okay. So again, a lot of folks, they held on, and unfortunately, if they didn't get out, they were in for quite a ride. Now, thankfully, the market has come back. I think the market would be okay looking forward into fourth quarter this year, first, second, third quarter next year. Lord willing, there's no more surprises out there that the economy is not ready for. Okay, so let me stop sharing my screen and go back to our illustrious video here. That's pretty much it. If you would like to receive an objective second opinion regarding the management and performance of your portfolio, my number is below, and also our email address. Keep in mind, we also provide a complimentary financial plan, written portfolio review. We don't charge for that. It's complimentary, and it's complimentary for our clients at least. So you've got to be a client to take advantage of it. But if you have any questions, feel free to give me a call. I'm happy to review your portfolio, your 401k, and give you some thoughts about the market and the economy as it relates to you and your risk tolerance. What I showed you a minute ago is not a recommendation. It's just sort of the position that we've taken here at WealthCare Financial Group. In order to give you advice, I have to understand more about your values, your needs, your goals, your income needs, your expenses, liabilities, your future retirement needs and income, your risk tolerance overall. So that's what we do here. We go in depth and we look at the entire picture. Okay, thank you so much for joining. And again, call if you have any questions. We're happy to be of assistance. You have a wonderful day. Take care.